The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Scorecard to Europe. It's Karen Cho with Juliana Tattlebaum and Steve Sedgwick. These are your headlines. Tech stocks hit by AI valuations fears once again. The Nasdaq shedding almost 2% and AI-linked names continuing declines in the Asian session.
Tesla shareholders approve Elon Musk's $1 trillion pay package in a deal designed to motivate the world's richest man to achieve the company's next set of lofty ambitions around humanoids and robo-taxis.
And the Bank of England keeping rates on hold in a very tight 5-4 decision, with the Governor Andrew Bailey casting the deciding vote. The Governor telling CNBC the UK economy is on standby ahead of this month's highly anticipated autumn budget.
When we look at the labour market, we do see it softening. I go around the country and there's a lot of talk about lower employment. I think that's actually lower hiring. It's not so much people being made redundant, but it hasn't particularly picked up.
Good morning, everyone. Some irony in the market today. We've had a sell-off stateside again on these AI fears, but then the Tesla shareholders voting for the very optimistic scenario around AI to play out. Humanoid robotics, that you've got robo-taxis coming, and that huge valuations will be hit by Tesla in coming years. So real irony that the market's been bookmarked by these two stories, that we've got stretch valuations, so you should take some powder off the table too. Look, Tesla is going to go in this direction.
I think this has not been a week for the faint-hearted. But as I've been saying throughout the week, valuation's not a catalyst. Yes, valuations are stretched according to many's measure, but that's been the case for some time. So what's been the catalyst for the selling we've seen this week? I would argue one of the big catalysts yesterday was the jobs data. We got some challenger data on the labor market showing that actually layoffs accelerated in the month of October. And in this data vacuum, I think there's a lot of emphasis on the few data points that we're getting.
So how did the markets actually react?
It was a tough day on the U.S. market yesterday. We saw all three of the majors end lower. The tech-heavy Nasdaq led the losses. You can see they're ending almost 2% lower. The S&P ended more than 1% lower, and the Dow showing a little bit more resilience. So very much where we were at the start of the week. Now, in terms of those AI plays, here's a closer look for you at how the single stocks evolved yesterday. Nvidia taking a sizable hit off almost 4% over the course of the session. Tesla down 3.5%. Palantir down more than 6%. Clearly, one of the key links between all these stocks as well is that they're big retail favorites, and there's been a lot of money pour in from the retail sector there. So that's the picture for the U.S. In terms of Asia, again, similar to what we saw earlier this week, we are seeing some sympathy selling in Asia, heavy move lower in SoftBank shares. That stock down more than 6.5%. But across the board in Asia, we are seeing selling pressure. Let's get straight to it then. We've got Dan Kemp with us, Chief Research and Investment Officer at Morningstar. Dan, great to have you on this pretty intense Friday morning. I think if you're a player in the market, and my sympathy goes out to anybody who's been long the market right now.
Why? They've cleaned up.
That's a fair point.
Why are you sympathetic to the bulls who have made like 20% on the Nasdaq this year?
I feel bad
You're
for anybody
so
who walks in and sees that
poor
their
little
portfolio
bulls having
has...
a 1.7% down for the week. Oh, hey, I'm just going to shed a tear for the bulls in the market. You real?
No, it's. I mean, I think I need to have a thicker skin. Obviously, we can't even invest in single stocks, so we're unaffected ourselves.
There's a 20% drop in SoftBank for the trading week. So to the point, what did you buy in the past week or so? Were you chasing some of the upside still at this level into year end? Santa Claus rally could be coming. So I guess the entry point does make a difference. But of course, to Steve's point, if you'd bought much earlier and you've enjoyed all this upside, then you're not shedding a tear at this point.
Well, Dan, what do you think of the selling that we've seen this week? What do you think is behind it? Is it all about valuation, or has there been another catalyst?
I'm not shedding too many tears either. I mean, it's been a pretty good year. It's been a very volatile year for investors, we know. A lot of people were really challenged by what went on in April. We've had a little bit of selling, but it's been a really concentrated market. And you've done pretty well in the US market so far this year. So it's still up 15% for the year. We would take that at the beginning of most years. And obviously, if you've been outside the US, you've been in emerging markets, then you've done very well indeed. And so yes, the catalyst will only emerge with hindsight. So there will be books written about this period where we'll go, that was the catalyst. We never see it coming up. But obviously, when you think about valuations, as you say, that is a warning signal. You don't know when people start paying attention to valuations, but it seems that in many cases they've started to get a little bit out of control, particularly in those concentrated AI names, and that may be causing people to just take a moment and step back. But remember, as Karen said, there's often a rally at the end of the year. These sort of big moves often end up in some sort of melt up at the end. That can be really painful. And so again, people need to be really thoughtful about what they're doing when they're changing portfolios right now.
And to add to that, and the historical nature of the usual Santa Claus rally, what we've seen this year is that every time there is a dip, investors swoop in to buy. We've been hearing, and we know that long-only investors are still underinvested in the market. Is there any reason to believe that we're not going to see investors just swoop in and buy this dip? Is it going to be different this time around relative to what we've seen in the last several weeks?
Well, it's impossible to say whether it will be different, but of course we've conditioned people for, as you say, for the last decade, saying whenever there's a dip, buy in because it's going to go further up. But now a lot of valuations are looking pretty stretched, and so I would say it's not about just buying the dip. It's about what are you buying? Are you buying things that offer decent value? Are you buying things that you can continue to hold even if some of that froth comes out of the market? Know what you're buying at the moment because that concentration in one theme is really quite extreme.
Oh, come on, Dan. Who you talk? Good morning, by the way. And we've already had a great conversation off air where we've done all this. But let me try and translate some of it. Come on, Dan. The fact of the matter is, they don't care. They don't care about the valuations. The fund managers don't care about the valuations. The people who voted for Elon Musk to get $1 trillion pay packet, they don't care about current valuations. They care about momentum as well, whether it's the fund manager, whether it's the retail, whether it's someone in between as well. And the momentum, as you quite rightly said to me off camera as well, we're more likely to have a melt up than a melt down.
Yeah. Steve, you are absolutely right, as ever. But remember, sorry, but it's Friday. But remember that valuations, that performance rather goes backwards through time. Okay, so remember that if we have a bad day tomorrow, that colours or Monday, that colours the returns today. If we keep having bad days, it kind of goes backward. And so people often regret the decisions that they make. So although people may not care about valuations, they may be focused on momentum. Again, that can change pretty rapidly.
And the other thing I said off camera is that you and I and anyone else who tries to talk some form of valuation sense about them, we're all out of a job because they don't care. They honestly don't care. They just want to trade the momentum rather than worrying about fundamentals as well. My question is about the retail investor as well. And again, you and I talked about this off camera and how dominant they've become, how they've screwed over the hedge funds, how they won in April, how a lot of these short players have been absolutely mullered by the meme stocks as well. The retail investor, how much damage do they have to take before they withdraw from this buy the dip strategy?
Well, again, I'm not going to shed too many tears for some of the investors you mentioned either. We're all grown ups.
No, because they still get their 2 and 20. I'm not worried about the hedges either, but if they are watching,
but you're right. How bad does the momentum have to get? And I think it's going to take a big move to drive people out of the market, given where we've been for the last decade. But I'm quite excited by that because, of course, people should be investing. Most people have got quite a lot of their investing career ahead of them.
Hang on, I thought we were talking to Dan Kemp. It sounds like Rachel Reeves. So you didn't mention the UK, sorry.
I didn't mention not yet. Well, but most people should be investing. But the key is to take that long-term view. Buy things that look genuinely attractive now and hold them for the next 5 to 10 years. Don't try and play that momentum. Don't try to just be in for a few days, weeks, months. That's the dangerous thing. Not the investing per se. It's that short-termism, which, as you say, is driving a lot of retail flows, but that can be really dangerous.
But so to your point of looking out for 5 years, don't technology stocks tick that box? I mean, if you look at the devil in the detail in recent weeks, 750k worth of GPUs were ordered from NVIDIA through major deals in UAE and also South Korea. Other deals, of course, in the works as well. You had Apple paying Google for its superior technology in AI. They're real deals that are bringing in real revenue at this point. If you're looking 5 years out, surely some of these technology stocks will hold up well.
That's a really good point, Karen. And I think when you look at valuations, though, if you do that fundamental valuation work, then, of course, a lot of these things are already built in. And so analysts are looking out 5, 10, 15 years, and most of those returns already seem to be in the price. So you need, for further gains, you need further unexpected upside. And I think that's going to be tough, given where expectations are at the moment. And in some cases, it looks like it's overblown already. So, yes, you're right. You have to think long-term. Yes, you'd expect growth companies to be able to deliver that growth, but that already seems to be in the price.
Can I turn to Europe? Because for me, the missing leg has been the European stock market performance in recent weeks. And the German stock market has been a great example of that. You've had momentum trades elsewhere, and that is not just in the United States. It's been in the Asian markets, Japan, for instance. But the German stock market has missed out. Now, as we see the selling take place to the downside, even these sideways trades here in Europe are going down. What do you make of the opportunity, and whether you do see more potential for European stocks?
Yeah, so we certainly do. We see some good opportunities in Europe, in the UK as well. We see markets that offer much better value. But again, you're right that when you have these big sell-offs, if you've been an investor who's been in, let's say, German stocks hoping to catch up, then often they get caught in that downside as well, because if the optimistic investors are selling down, then they're selling everything. But that's where that longer-term perspective is so important, that you might get really good opportunities to buy in, whereas if you have expensive stocks just going from very expensive to a bit expensive, that's not such a good long-term proposition.
So how tactical would you be in this selling moment? Would you be looking for sectors, stocks? How are you playing it?
So first of all, I don't believe in tactical investing.
Dynamic trading is what we call it these days.
Yeah, we always come up with new names for it.
Yeah.
But I think that idea of doing something today with the expectation of doing something tomorrow isn't really investing. Really investing is taking that long-term valuation-driven perspective. And so if you're making that decision today, then yes, there's still good value out there. But in a market where things look so stretched, you've got to be psychologically strong enough to be able to hold on to these positions if they fall over the next few weeks. So I wouldn't try to trade it tactically, but make sure you're buying things that you'd be comfortable to own for the next few years.
Dan, let me wrap up with the U.S. economy, because it feels like that has been somewhat central to the narrative this week, the little bit of jobs data that we've had come through, and it's really painted a mixed picture of the U.S. economy. The ADP report earlier this week painted a slightly more encouraging picture, but then the Challenger data yesterday, I don't know if you had a chance to look through it, but showed that we've seen a massive surge in layoff announcements in October. So now I think the market's thinking maybe there is going to be an economic slowdown there. How are you thinking about the U.S. economy and also how the market's interpreting right now good versus bad data?
Well, I do feel sorry for economists. I mean, it's a really tough time.
Finally, some sympathy for some bucket.
When you have the federal government shut down, you have limited data.
Well, they get paid vast. Do you know, we had an economist the other day who basically said, if I get basically 50% of my calls right at the moment, I'm really happy. So, and by the way, I'm just drinking water rather than gin. Although this conversation makes me want to go to gin sometimes. But the fact of the matter is, Dan, they get paid vast amounts of money for getting half their calls wrong.
Well, I didn't say that they're
You said
brilliant.
you feel sorry for them.
Well, yes, of course, because if you have very limited data, then you have to focus on the data you have available, and that's really tough at the moment. And you have to try and come up with these forecasts based on very limited data. And so it is a tough time for them. But I think it's a good time for investors to remember that there's a pretty weak link between near-term economics, particularly backward-looking data, and investments, which are always forward-looking. Company data always forward-looking, and so I think when we think about the economic situation at the moment, then certainly people shouldn't be spooked by the news coming out, and people should be thinking about that long term again, because again it may drive change in sentiment, as Steve mentioned earlier, but certainly not something that people should be basing decisions on.
Well, at least they have an excuse stateside. I mean, here they got it wrong with some calls for a rate cut and ahead of the data, so at least there is an out for them at this point.
Well, there we go. So maybe excuses. Maybe we shouldn't feel sorry for them either.
Exactly, Dan. Thank you so much for joining us, Dan Kemp, Chief Research and Investment Officer at Morningstar. Tesla shareholders have voted to approve a historic pay package for CEO Elon Musk that could be worth almost $1 trillion, with the proposal receiving 75% support amongst voting shares. The package consists of 12 lots of shares, which will be given to Musk if Tesla meets certain milestones over the next 10 years. Musk spoke to Tesla shareholders after the vote, sounding a bullish note on the company's push into autonomous technology.
Things do get kind of wild from an economic standpoint, because at a certain point with AI and robotics, you can actually increase the global economy by a factor of 10 or maybe 100. There's not like an obvious limit. So like Optimus is kind of like an infinite money glitch. So I guess what I'm saying is hang on to your Tesla stock.
Arjun joins us with more. Arjun, Elon Musk had a spring in his step as he bounded onto the stage. A $1 trillion spring in his step.
Absolutely. Look, the investors in Tesla believe this is very much as much about Elon Musk as it is about the company, right? And they believe Tesla's long-term success is inextricably linked to Elon Musk. He has to be the guy to sort of lead this company forward. No one's pay has been more focused on, more scrutinized, and certainly not as big as Elon Musk's in history. And of course, the key here is this pay packet is linked to a number of goals around market cap as well as company performance. You know, the first tranche, he gets a $2 trillion market cap. I think they're at just under 1.5 now. Then increments of 500 million, and then two increments of 2 trillion up to 8.5 trillion. So these are quite large numbers. There's performance goals around profitability, around vehicle deliveries, full self-driving subscription, even the Optimus robot. So he has to hit these in order to unlock these tranches of the pay package. But of course, if he's able to do this, many believe that this is key to unlocking Tesla's future beyond just electric vehicles.
To me, the milestones are significant. That 8.5 trillion he has to get to the end of the road. That is a 5 trillion comparison to where Nvidia was recently, the only company we know vaguely in that range, so whether he can get the momentum into the stock. But what about the technology? Because the humanoid robotic division, while it sounds fantastic, you and I have both seen them in person. They clomp around the room. They're not quite there in terms of mass market just yet.
And I think also the question is, what is that market? You know, I think the goal was 1 million Optimus robots were one of the tranches in that. What does that look like? And also, this is, again, not an area without competition. Just a few days ago, the Chinese electric vehicle maker XPeng was debuting some of their next-generation robotics, and you're going to see more and more companies push into this. So just like Tesla's encountered competition in electric vehicles, I think there's a very unclear market right now for robotics and humanoid robots. And if that market does take off, there will be more competition as well. Of course, like when you think about the market cap here, a lot of investors will tell you, well, look, it's all about autonomy. They use this word autonomy, and this is talking about robo-taxis, it's talking about driverless cars, it's talking about robotics as well. And they're saying, well, this is the future of Tesla, not just the cars. And so this sort of pay packet is very much linked to that vision that many investors have, that Tesla is going to be more than just a car company. And if it is, then it will be able to hit these lofty heights of trillions of dollars in market cap.
Arjun, we know that not every shareholder was on board with approving this pay package. Norway's sovereign wealth fund notably opposing the package, and other shareholders as well. What was the main pushback to the pay package? Was it the numbers themselves, or was it the incentive it creates to sort of rush innovation and potentially risk the safety of some of these things that Tesla's coming out with?
Yeah, I think there's a couple of things. One was certainly the number and the figure itself. The other thing they flagged was key man risk. So one of the big parts of this whole deal and the pay packet is Musk's ownership. So if it is fully vested and he hits all these goals, he effectively gets 25% of Tesla, control of Tesla. One of the things Elon Musk has argued is that if Tesla's going to build all this very powerful technology, AI, robotics, etc., he believes he needs to sort of be the steward of that very powerful technology, and he believes that if he has that much control, he's able to fend off any outside interests, potential takeovers of Tesla, which owns this very powerful technology. And so that's been his argument so far. But of course, that does create lots of questions. Why should he be the person in charge of that technology? Why? What if he sort of moves his attention elsewhere? He's got lots of other businesses, SpaceX, XAI, X, etc. So these are all continued concerns around Elon Musk, any further political involvement. And that is one of the big, I think, concerns from shareholders who oppose this deal, is that key man risk in the mix here.
It makes sense. Arj, thank you for running us through all of it. Appreciate you joining us this morning. Coming up on the program, Bank of England keeps rates at 4%, with Governor Andrew Bailey casting the deciding vote. We'll discuss more next. Plus, Comcast makes a splash with reports the media conglomerate could be considering bids for Warner Brothers Discovery and ITV assets. More on that this hour. And EDP presents its business plan for the next 2 years. We'll speak to the CEO at 7:30 GMT.
The UK Chancellor of the Exchequer, Rachel Reeves, has reportedly told the Office for Budget Responsibility she plans to increase income tax in this month's budget. That's very interesting. There's a lot of people wondering whether it's a feint at the moment. Anyway, that's according to The Times, which says the watchdog will model the impact the move could have before sharing its forecast with the Treasury on Monday. Hiking income tax would make Reeves the first Chancellor to do so. It was Dennis Healey, wasn't it? You guys weren't probably alive when Dennis Healey did it. I was. More than half a century ago. Gosh, I am old. Of course, no decision is final until Budget Day. Thank you. According to the report, Reeves will go ahead with a policy first floated by the Resolution Foundation and balance the 2% increase with a 2% cut. I beg your pardon, 2 pence cut to national insurance contributions, shifting the tax burden towards those who don't earn their money through employment. Oh, it's all about the workers. I'm a worker. But those who make just over £50,000 a year in salary could see their national insurance payment remain the same, as Reeves seeks to make sure those with the, quote, broadest shoulders take the hit. We're already taking the hit. Have you not seen the share of tax at the top, whatever percentage earn and what they pay? It's basically was 13% in the year 2000. It's now 29%. The broadest shoulders already got it, madam. Anyway, the Bank of England kept rates at 4% in its latest monetary policy decision on Thursday, with Governor Andrew Bailey effectively casting the deciding vote in a knife-edge 5-4 split. Gosh, that sounds exciting. For the first time, the Monetary Policy Committee members provided individual reasoning for their decisions, with Bailey indicating that while he finds the downside risk more convincing, he prefers to wait for further development. What further developments could he possibly be waiting for, Ritika Gupta, who interviewed him yesterday? And it was a great interview, by the way. Why are they... No, they're central bankers. They have to be very careful. I get it, of course. But the further developments mean one thing and one thing only. We all know it, and that is how bad or how good the budget goes down.
Yeah, and that's one thing that they don't actually include in their forecasts for the economy. So, yeah, maybe their forecasts...
But that's what he meant, isn't it?
Maybe their forecasts become redundant pretty quickly.
Yeah.
But as you mentioned, it was a tight vote. It was a hold as the markets expected, even though, as we were discussing in yesterday's show, there were some growing calls from some of the banks that maybe we would get a surprise rate cut of 25 basis points. But again, the vote, very tight, 5-4 split. The majority, of course, opting to hold rates steady. Governor Andrew Bailey being in that camp, he was said to be the decisive vote this time around. Now, the MPC said that overall, the two key risks are more balanced this time, that the risk of persistent inflation is less pronounced, and he says that inflation peaked at 3.8%, and more apparent is the risk of weakening demand. Now, this is the first time since they began that rate-cutting cycle in August 2024 that they broke away from this once-a-quarter pace of rate cuts. And I asked Andrew Bailey about what changed this time since August and led them not to cut, and what more that they want to see from the data. Take a listen.
Two things I would particularly pick out. The first one is that when we look at the labour market, we do see it softening. I go around the country and there's a lot of talk about lower employment. I think that's actually lower hiring. It's not so much people being made redundant. That it hasn't particularly picked up. But I think a lot of companies talk to me about reducing their hiring and their hiring intention. So I think we are seeing some softening in the labour market. I think we're seeing a bit of that in the way pay measures, particularly in the private sector, are coming down now. They a little bit undershot in the 3 months since August where we thought they would be. So that's one set of things. And then on the inflation front, and obviously our job is to get inflation back to its 2% target. The first time, and the latest number we've had sort of a couple of weeks ago, we saw it just begin to undershoot where we thought it might go to. B, we thought this would be the peak around now. I think there's a little bit more confidence that's the case, and it may have peaked at a little bit of a lower level. But we'll have to watch this very carefully.
So what more do you still need to see in the data then to warrant a rate cut? Because as we've mentioned, it has slowed since September, and you've said that the latest inflation print is promising, but it's just 1 month.
Yes.
But when you look at the constellation of data misses that we've had now, whether it's inflation, wages, undershooting activity, is that range of data enough to tell the story? Or
well, I think again, the constellation, as you say, is the one we will continue to, I think, look quite we will look intensively at. And I just come back to the point about the inflation number, because I think that's obviously important because it's our target, obviously. 1 month is a good, obviously good news. And by the way, it was reasonably broadly based across the components of inflation, which is also important. We sometimes get months where it goes under, and the staff say to us, but there's one particularly erratic thing in there, so don't sort of count your chickens. It was more broadly based, but one number isn't, it doesn't make it, as it were. I think we need to see that picture now sort of be more established. That's what I'll be looking for.
So in terms of a timeline of that?
Well, we'll see. I mean, as I said, I've said in the paragraph that I've written for the minutes this time, in our New Style minutes, that I'll certainly be looking at the rest of this year, and the evidence we see between now and our last meeting, because we've got one more meeting this year. And we have got 2 rounds of the data in our meeting schedules mean that for the next meeting we'll have 2 rounds of data before we next take a decision, because that's the way the schedules fall.
That was the Governor of the Bank of England, Andrew Bailey, there on what more he needs to see from the data to indeed warrant a rate cut. Bailey says that he sees the value in waiting for more evidence. He said that the CPI coming down is promising, but it is just 1 month of data. So he's putting greater weight on the risk of persistent inflation. But again, the question of the autumn budget looms large. So we'll have to see how that plays out.
Just 20 seconds on the gilt market. How much is there a nod to instability potentially in the gilt market, coming potentially from the budget, why also they would like to give an extra bulwark to the bull market by having high rates?
Well, the gilt market has been rallying in the run-up to this budget, because there is this expectation. She has set the stage pretty clearly that there's going to be tax rises. She's also talked about cutting the cost of living. So there is this expectation that we're going to get tax rises. We're also going to have interest rate cuts because the economy may be squeezed. There is going to be maybe this path of disinflation set up ahead of us. So that's really what we're seeing in the gilt markets reacting to that.